Today, I'm going to share with you what is EF, why a lot of developers and agents are talking about it, and why developers are even so desperate to protect it. So EF stands for end financing. There are two main financing in a property development, namely bridge financing and end financing, whereby the bridge financing, we call it BF, in this case is used by the developers to bridge the financing to use the fund for the construction mainly, and it needs to be paid off in a lump sum at the end of the loan period, whereby the EF is used to help house buyers to finance their purchase of the property. So now let's focus on the EF part. So where to find EF? EF can only be found actually in the undercon market, or we call it the primary market, but not in subsude, or we call it the secondary market. Why? Because the value of the undercon property would be predetermined by the EF before construction and is normally listed in the APDL by the banks that provide the EF to that specific development. And banks will have done their viability study before they confirm to provide the EF to the particular development. And why subsale won't have EF? Because the value of the subsale unit or the units that are available in the secondary market would be now determined by the registered valuers or using AVM, automated valuation model. And normally, the banks that provide BF to a specific development would also provide EF as well, and would normally have the largest shares for the EF of that particular property. So what about the EF limits? So each bank has a limited EF limit, which is based on their annual mortgage budget and which can be expressed either in a percentage form or in a nominal amount, right? Say 10 million ringgit Malaysia, or for both, but for whichever comes first, etc. So once the EF limit is reached, the banks would either stop to provide the EF to the development, or they renew the EF to increase the limit, but to a certain extent, up to the maximum allowable risk that they can bear, or the reserved EF quota of the year. So here's the bonus. Normally, EF comes with a preset LTV for a particular unit or for the whole project. Say for project A, Tiger Banks provide EF for the project up to 90% LTV. But when the banks detected the extra rebates given by the developers to the house buyers, then they would normally slash the margin of the LTV at a lower amount, providing lesser LTV to the development to try to match as close as possible to the real value of the property, in which the worst scenario is that once buyers cannot pay the mortgage, then the bank can sell off the property under the mortgage to get back their capital. So in order to reduce the risk of not getting back the capital loaned to the defaulters, in the case of rebates given by developers, they will actually reduce the LTV amount to the particular property. EF is very important in a property development to the developers and house buyers, and also the banks. Number two is that EF is only applicable to the primary market, but not in the secondary market. And number three is that developers won't disclose actual rebates to the banks to allow the house buyers to get cashback or buying with zero down payment at the minimum, or with minimal down payment payable to increase the uptake rate of the property. Although this is dangerous from the bank's perspectives. So in order to protect their interests, they will normally reduce the LTV provided in the EF of a particular property to reduce their risk of not getting back their capital in the scenario whereby the loans are being defaulted. And if you're not sure about what is cashback, please refer back to my previous video about what is cashback and the pros and cons of cashback. Thanks for watching, and if you want to learn more about property,
please hit the like, share, and subscribe button and turn on notifications. I will see you in my next video. 出生在口袋，有个背后。